3 pieces of advice. D. Trust yourself to win the world. Never abandon your familiar investment strategies, even if they currently yield little profit in the stock market. Avoid adopting unfamiliar investment methods that lack theoretical and practical validation, as they may lead to substantial losses. R. Warren Buffett once said, among contemporary investors, there is little difference in technical skills. The key factor distinguishing winners from losers is whether they consistently apply their familiar investment strategies. While this approach may seem conservative, our sole purpose is to make money. Fun. When examining Buffett's investment history, we find that he typically employs well-practiced investment strategies and only invests in areas he understands. Before venturing into a new field, he spends considerable time familiarizing himself with the industry. It is precisely this seemingly conservative investment philosophy that has made him a stock market genius. The following story vividly illustrates the importance of expertise in one's field. If you step into unfamiliar territory with blind confidence, you may face significant challenges. A PhD graduate joined a financial company, becoming the most highly educated employee. He was arrogant, dismissing others and believing he knew everything. However, a small incident changed his perspective. One day, he went fishing by a pond behind the company, where both the director and deputy director were also fishing. They greeted him, but he merely nodded, thinking there was nothing to discuss with these college graduates. Shortly after, the director put down his fishing rod and swiftly ran across the water to the restroom. The PhD graduate's eyes widened in disbelief. Was he walking on water? Before he could recover, the director flew back across the water's surface. Now thoroughly bewildered, the PhD graduate witnessed the deputy director perform the same feat. He wondered, have I stumbled into a place filled with martial arts masters? When the PhD graduate needed to use the restroom, he faced a dilemma. The pond had walls on both sides, and the restroom was a 10-minute walk away. Reluctant to ask the directors, he decided to step onto the water himself, thinking, I refuse to believe that only college graduates can cross this pond. However, as soon as he lifted his foot, he heard a loud splash. He had fallen into the water. The directors pulled him out and asked why he had jumped in. He inquired, how were you able to walk on water? The directors exchanged a knowing smile. There are 2 rows of submerged wooden stakes in the pond due to recent rain. We know their positions, allowing us to step on them. Why didn't you ask? This story highlights the consequences of venturing into unfamiliar territory. Fortunately, the PhD graduate only fell into water. In the stock market, such missteps could lead to much greater losses. Recognize the blind spots in areas you don't understand, and avoid testing uncharted waters. The pitfalls may leave you battered and bruised. Section E. Mastery through repetition. Repetition is key to mastery. By consistently practicing simple actions, you can become proficient and even achieve perfection in specific techniques. This principle applies to stock market investing as well. Rather than constantly worrying about market fluctuations, focus on following your rules and improving the quality of each trade. The journey to becoming a seasoned stock investor involves designing your own investment approach, refining it through iterations, and ultimately sticking to your chosen method. Even seemingly mundane strategies, when executed with ease, can reveal exceptional investment prowess. For instance, consider an investor who consistently earns an average annual return of 10% without ever incurring losses. Over time, this disciplined approach can lead to substantial gains. Warren Buffett, the renowned investor, follows a classic investment strategy. He seeks undervalued stocks in monopolistic industries, conducts intrinsic value analysis, which we'll explore later, and buys when prices are low. Then, he patiently waits for the market to recognize the value. Buffett's long-term perspective and unwavering commitment to his chosen method have contributed to his immense wealth. Remember, it's essential to avoid unfamiliar investment approaches. If you lack familiarity with a strategy, refrain from using it. Even seemingly straightforward investments can be dangerous if you're not well versed in their workings. Stay within your comfort zone and focus on what you know best. Section 2. The Solitude of Wisdom. Almost all successful investors are solitary individuals. They stand out because they think independently and often diverge from the crowd. Warren Buffett exemplifies this trait. He adheres to his investment principles regardless of popular opinion. As Buddha wisely said, self-examination is the key to self-understanding. Trust your own judgment rather than blindly following others. Being different is essential. It's about having the confidence to pursue your convictions. Don't merely oppose the majority for the sake of it. Instead, cultivate a unique mindset that allows you to foresee outcomes and maintain confidence in your decisions. Remember, it's not about being contrarian just to stand out, it's about having a distinct thought process. In the stock market, relying solely on others' opinions can be detrimental. Develop a long-term perspective and a keen intuition that transcends popular commentary. While market analysts may sway the behavior of retail investors, true investment professionals remain independent and unaffected by external noise. So, trust yourself. You are more critical than anyone else in your investment journey. As you gain experience, you'll realize that self-reliance is the hallmark of a mature investor. Section 3. Don't do business if you're not familiar. Another layer of meaning behind the phrase "don't do business if you're not familiar" is to invest in areas you know well, rather than venturing into unfamiliar territory. Warren Buffett has never been interested in fields he doesn't understand. In China, there's an old saying that goes, "Don't do business if you're not familiar." Buffett follows a similar practice. He avoids stocks he isn't familiar with. Let's analyze Buffett's investment portfolio in 2003, as shown in the table. The principle of "don't do business if you're not familiar" is evident in his choices. Buffett has long held shares in Coca-Cola, a company he knows inside out. For other companies, Buffett closely tracks them for years before making a move. His investment in PetroChina wasn't a sudden decision. He focuses on energy stocks, an area where he excels. PetroChina, being a dominant player in China's energy sector, aligns with his expertise. Buffett favors companies that dominate specific fields and that he thoroughly understands. From a long-term perspective, it's hard to conclude whether the business risks of Coca-Cola and Gillette are much lower than those of other computer or retail companies. Globally, Coca-Cola sells approximately 44% of beverages, while Gillette holds over 60%, by value, of the razor blade market. Besides, I don't know of any other company that has had such global influence for such a long time. He even humorously remarked that considering the 2.5 billion men growing facial hair every night, razors are essential items found in their bathrooms, allowing him to sleep well. In the 1960s, electronic stocks were all the rage on Wall Street. While smart investors like Philip Fisher and Fisher Investments began long-term investments in the 1950s, others only realized the potential a decade later. Short-term trends create heroes, and indeed, some fund managers made a fortune by speculating on tech stocks. However, Buffett refrained from such speculation, believing, for investment decisions, if the technology is crucial but I don't understand it, we won't enter that trade. I have a good understanding of semiconductors and integrated circuits. Thus, over 20 years ago, Buffett didn't get caught up in the electronic stock frenzy, just as he avoids the current hype around high-tech internet stocks. His subsidiaries have been acquiring companies in traditional sectors, such as Benjamin Moore and jewelry companies. Buffett's name has become even more renowned because he consistently avoids stocks in industries he's unfamiliar with, especially high-tech internet stocks. Since 1997, during the tech-dominated bull market in U.S. stocks, Buffett's blue-chip stock investments have lagged behind the market. Eventually, whether due to money, facts, or a new perspective, Buffett ventured into two previously unexplored areas, the energy and telecommunications industries. His explanation: perhaps it should be said that the market has changed. A dedicated value investor should seek new rules and opportunities in the new market environment, but fundamental principles shouldn't be abandoned. Although Buffett explored new environments as a seasoned investor, he wouldn't act without reasonable certainty. In 2000, during the dot-com bubble, Buffett refrained from buying internet stocks. At the time, many believed he was falling behind. However, in hindsight, the internet bubble buried a host of speculative investors, while Buffett once again demonstrated his steady investment mastery, emerging as the biggest winner. Whether it's internet stocks, energy stocks, or telecom stocks, Buffett's ultimate goal remains consistent: making money. Therefore, he doesn't get swayed by unfamiliar or opaque sectors. Even in today's hot industries, he remains calm until he truly understands them. This example doesn't discourage investing in internet stocks. Rather, it emphasizes the importance of thorough research before any investment decision. Don't rush into decisions without a clear understanding. For instance, despite low deposit interest rates, it's essential to consider options carefully. In a bearish stock market, many turn to stamp collecting, forex trading, futures, or real estate investment. However, these channels aren't necessarily less risky than the stock market and often involve greater complexity. When uncertain, keeping money in savings is safer than blind speculation. Statistics show that bank savings remain the preferred choice. Peace of mind leads to prosperity, and with numerous investment opportunities ahead, having cash on hand ensures you won't miss out. Section 4. Tactical Analysis. Warren Buffett, with years of investment experience, has developed his unique investment approach, which we can call the Buffett three-step investment trilogy: scouting, waiting, and striking. B. Scouting. Buffett begins by comparing companies that pique his interest. Once he identifies a promising company, he closely monitors it for the long term. R. Waiting. He patiently waits for the right price. Rather than rushing into investments, he observes market corrections and allows stocks to achieve reasonable valuations. 5. Striking. When the opportune moment arrives, Buffett makes his move. He invests with conviction, leveraging the insights gained from thorough analysis. Buffett's mastery of this investment trilogy is evident in his seamless execution. His approach has become a classic in the stock market, inspiring countless investors to follow suit. In the 1970s, Buffett set his sights on the government employees' insurance company, Geico. Despite its consistent performance and ample cash reserves, Geico's stock price remained undervalued. Buffett recognized the potential. The company's cash could fund acquisitions at minimal cost. Additionally, as living standards rose and individualism thrived in the United States, the insurance industry held promise. However, Geico's stock price remained stubbornly low due to factors like intense price competition and rising operating costs. Buffett patiently observed, waiting for the right opportunity. Finally, in early 1976, Geico announced a staggering loss of $126 million for the previous year, causing its stock price to plummet. While others saw decline, Buffett saw opportunity. The insurance industry was experiencing temporary chaos due to new entrants, fierce price wars, and other factors. Geico's low-cost operating model gave it a competitive edge, making it an attractive investment. Buffett seized the moment, purchasing 500,000 shares of Geico stock when it hit $2 per share. Later, when Geico planned to issue $76 million in preferred stock, Buffett didn't hesitate to buy 25% of it. His investment injected much-needed capital into Geico, reviving the company. Over 6 months, Geico's stock price quadrupled to $8 per share. In subsequent years, Buffett doubled down on his investment, becoming a controlling shareholder. Buffett emphasized his commitment to holding Geico, making it a vital source of acquisition funds. Thus, the Buffett three-step investment trilogy: scouting, waiting, and striking remains a cornerstone of his success.